My next guest started a hedge fund this year to invest in liquid securities, including stocks, bonds, and derivatives, and goes both short and long. Roshan Padamadan is founder of fund manager of Luminance Global Fund. He joins us from Singapore. When it comes to hedging, the volatility of last week has certainly added a lot of interest in this arena. Where do you think it goes from here? Have markets calmed down a little bit? Or can we expect more volatility to come and more excitement in this space?
Good morning, Angie. Thank you for having me. We are expecting a lot more volatility going forward, so we are prepared for more volatility from this level onwards. We are seeing Asia generally having a lot of earnings coming up, and the unrest in Hong Kong will certainly add to the volatile situation. People will reassess risk premiums for Hong Kong, so there is a longer-term impact. It's not just a one-week thing. It is something which will have impact over 3 weeks, 3 months, and so on.
Can you tell us a little bit more about why you think that way in terms of Hong Kong's Occupy Hong Kong? I mean, the sentiment has been that, broadly speaking, that this might be a short-term hit. But why do you not think so?
It just showed that one country, two systems is not really a done deal. So it has highlighted this issue to the investing public. So now investors from abroad, from the West, from the US, they will reassess how to assess Hong Kong. It is not just like China but not China. So they will have to reassess whether the investments will be treated differently. So now you can imagine the impact on Macau gaming, the impact on Hong Kong property and Hong Kong retail. It will all be negative, and we will see the full impact as the next quarter earnings comes out. So we will see the impact over several months. The longer-term view, if you take a 3-year view, is that people might reassess Hong Kong as a base for operations. They could choose, for a multinational corporation, they could choose Singapore as a base rather than Hong Kong and so on, given they're both in Asia and they have to choose a leading financial center. So that is a longer-term assessment which could change as well.
All right, let's talk about Hong Kong-Shanghai Connect here. You've made the assessment. You have a playbook ready. But, of course, everybody is wondering when this thing is going to get off the ground. What happens in terms of your playbook when it actually does come to fruition?
So the playbook is in 2 parts. One is there is arbitrage trades. So the arbitrage trade will depend on prices on the day. So there are some Shanghai names which are much cheaper than their equivalent Hong Kong names, and vice versa as well. So we would see demand from different sets of investors go across the border. Mainland Chinese investors can buy for the first time some gaming stocks, which they do not have on Shanghai. Shanghai investors will benefit from this diversification. For Hong Kong investors, they can go north and buy some utility names and other names which are much cheaper on the Hong Kong, on Shanghai. The yields are better. It's essentially the same stock. So you have this arbitrage trade. The other trade is you can just go buy deep value. China is the cheapest large market out there. You can find a lot of blue chip stocks. They are blue chip in my view, at around 10 times earnings and giving you dividend yields of 4-5%. So these are quite attractive to value investors, and we would expect a lot of demand from foreign investors from the US as well. Some of them, of course, already have access through the quota system. But this just opens up the space to other managers who were not able to get the RQ fee quotas and so on to get access to the market.
All right, in this environment, is deep value the way to go, not only for China, but how about Japan?
Well, in Japan, deep value is very different because the catalysts all seem to come from the currency, and we are not very sure that currency is the right way to play Japan. Things like changing the currency to improve your competitiveness is something what emerging markets do. If Japan is also doing that, it's not a very sustainable model. So we don't believe in playing the currency play. So we look for companies which have a product which is not easily replicable. Most of Japan's traditional strengths are easily replicated by the Chinese and the Koreans. So the Chinese and the Koreans also make cars, they also make good steel, they also make displays and electronics. So Japan has to do something different, maybe offer some complete solutions or go higher up the value chain. In terms of, in general, Japan has a lot of value names, but you might be in it for a long time. So we would rather look for names where there is an imminent catalyst or the product is not easily replicable.
All right, Roshan Padamadan, we're going to leave it there. Luminance Global Fund founder and fund manager joining us.